market will do whatever it takes to make the greatest fool out of the greatest number of people to the greatest possible extent. Disruption creates opportunity. If you build it, they will come when volatility is already happening. You have to do that. You have to personally prepare yourself, mentally prepare yourself well before that volatility happens.
Gold is up 45, real estate's up 40-ish, silver, you can just go down the line. My contention is that, are they really up that way? Or is just the dollar worth 70% of what it was before?
Equity market's hitting new all-time highs. Now, I've had people say it's, global chaos.
We're going to have inflation, right? Because you're getting stimulative policy from fiscal and monetary into a strong economy. Tech is to say, we know it's crowded, we know it's expensive. Here's the other catch. Tech earnings estimates are for 17% in 2024. They're now forecasted for 25 to accelerate to 25%. Now, that's happening in the context of NVIDIA, one of the largest weights in tech, going from 140% growth down to 40% growth.
Welcome to a special edition of our show. We are coming to you from Orlando at The Money Show. I'm Jim Iuorio. That's Bob Iaccino. Of course, in the middle is Cameron Dawson, who is the Chief Investment Officer of New Edge Wealth. I got it right, didn't I?
You did.
Good.
You did.
By the way,
Impressed.
every thank you. I live to impress.
It's a low bar.
Right, it's a low bar. Every Saturday morning, swear to God, not just blowing smoke. I wake up, I get your Saturday morning read, and that's the first thing I do. Particularly if I'm doing Kudlow's show like at 11, because I just use all your words and pretend like they were my own.
Happy to help.
Sure, no worries at all. So anyway, this morning you were talking about the rally, multiples, valuations, expansions. Can you expand on that theme and tell us, we all want to know, are we correct in 10% anytime soon? What are your thoughts?
Yeah, well, the first one is that it was always music themed and on Saturday mornings. So this week's theme was My Chemical Romance's famous last words, with this idea that when people go and try to justify very high valuations, mostly versus history, that there's a famous last words aspect to it, is that we typically see these peaks in valuation as people are trying to justify them just at the moment that you should be questioning whether that valuation is justified. So as we look at the equity market today, we can see that the S&P 500 is trading at 22 times forward earnings. There's only 2 times in the last 40 years that it's been more expensive. At the COVID peak in 2020, it got up to about 23 times. And then, of course, during the 2000s tech bubble. And what we go through in the piece is say, look, there's some justification for why valuations have moved up so much, even as the Fed hasn't really eased policy that much. We talk about things like treasury liquidity. We talk about the fact that growth expectations are still moving higher. Look at EPS estimates over the 12-month rolling forward basis continue to climb higher. We also talk about this idea of scarcity, and I think this is really important. We continue to see a lot of liquidity sloshing around. Look at those money market accounts. Look at the fact that this is Guggenheim's number. They talk about $7 trillion of excess liquidity pumped into the market really since the pandemic with its policy response. But what's interesting is that the supply of stocks is not going up. You have a lot more buybacks than you have equity issuance by a significant degree. There's only been $130 billion of equity issuance this year. There's been $1.1 trillion of buybacks. So we appreciate the fact that there are things like this scarcity that's driving valuations higher, but we think we've now reached a point where valuation expansion cannot be counted on for further upside in markets. It leaves you to expect that earnings would be the key driver of further upside. And the question we ask is that what could cause valuations to fall? What could cause that PE multiple to go from 22 times down to 20 or 18 times? And we think it comes in 2 camps, either much higher interest rates, that 10-year treasury moving higher, or a cutting cycle to earnings. And the last part of this, sorry for a long-winded answer,
No.
The last part of this that's really interesting is that over the last 2 months, we've actually seen both of those things happen, higher 10-year treasury yields and having cuts to earnings estimates, only about 1%, but they're still there, they're cutting, and yet you've still seen this valuation expansion. So there's a divergence that's brewing in this market that I think warrants our attention.
So my follow-up question, I want you to pick one of these two questions, okay? Because I was going to ask you about Goldman.
It's a choose
It's
your
a
own
choose,
adventure.
yeah, right. I should have cards. Like Goldman came out saying expect 3% returns in the S&P over the next 2 years. I think that's largely crap. Whatever. My second question, which I'd rather you answer, is that I was going to ask you to comment on that, but the one I'd rather you answer. I just wrote a Substack about, in 3.5 years, S&P's up 54%, gold is up 45, real estate's up 40-ish, silver. You can just go down the line. My contention is that, are they really up that way? Or is just the dollar worth 70% of what it was before? And the reason I think that that's significant is because when we're looking for bubbles, it's not speculative fervor. It's just that the dollar's crap in comparison to what it was 3.5 years ago. What's your comment on that?
I mean, there obviously is an aspect of the debasement of the purchasing power of the dollar. The DXY index, I'd have to go back and check as to where that is versus where it was 3 years ago.
Sure, but that's against the yen and the euro largely.
Yes.
Yes. Okay.
Yeah. So everybody's money going less far
Yeah.
does mean that if we think of a single stock as a unit, that yes, it you pay more for it because the dollar goes less far.
Right.
What I'd say about forward returns is, and I do like your point though, that you're not seeing the same kind of speculative fervor like you saw in 2020 or in 1999, 2000, but you're starting to see a little bit of it bubble up, and that's where you should watch things like FINRA margin loan balances. You should watch the periphery of the market, your IPOs, your meme coins, your different areas, high beta stocks that typically do catch that speculative fervor. Watch those closely, because it wouldn't be too surprising, given what the Fed is doing, given what fiscal policy is doing, that if you're just throwing lighter fluid onto what is already a strong environment, that you get that speculative bubble up. On the forward returns, there's something that every time people talk about lower forward returns, they're missing something really important. It's that the path to lower forward returns can be very varied. You could say, I think we're going to have below average forward returns. But to get to below average, you could have a huge rally and then a crash. You could have a crash and
That's
then
a
a
great
rally,
point. Yeah.
or you could just chop sideways and not, kind of be on the road to nowhere. So that's where you can make these projections and say over the next 3 years or 5 years, forward returns will be lower. But then that's when you have to filter in the shorter term considerations like the technicals, where valuations are, where positioning is, where sentiment is. All of those things have to fit together, because if you listen to people talking about lower forward returns within U.S. equity markets a decade ago, because that's what all of the forecasts on the street were for U.S. equity markets are overpriced and by EM. And that caused you to get out of U.S. equity markets. You missed it. You were wrong. And so there's a certain aspect of it is some of the models are broken. The other one is it's path dependent.
So sorry about the two microphones, but Jim and I had to cut costs.
You're so
somewhere.
much louder than I am.
Yeah, no, we had to cut costs somewhere, so we decided to go with two microphones to make this easier. From a standpoint of process, okay, like a philosophical question, Jim and I are more active investors, active traders, and I honestly think the money show is probably dominated by that. And you're in the money management space, so I'm making an assumption that that means more longer term. I feel like medium term sort of gets dismissed. And is that important from a perspective of what you do? Because I like to look at medium term sort of as what I should be doing in the short term.
What's medium term?
Well, medium term to me is like the S&P's in a bull market, period, right? I was on Neil Cavuto's show the other day, and he said, how long do you think this particular bull market lasts? I said, another 8 years, but that means very little to me, right? I'm looking at, okay, if we go into a downturn, I'm going to be looking for short trades or, put spreads. And if we stay in this uptrend, I'm looking more for long trades. The medium term to me, everybody says 12 to 18 months. I'm going to say 12 to 16, just to be different. Is the medium term important for either the active or the long-term investor?
Look, I think that this notion that I'm a long-term investor, which means I don't have to think about anything, is misguided, because even the longest-term investor still has to make short-term tactical decisions. I have to make a decision of, I have cash that came in, where do I reinvest it? I have to make decisions of, hey, I have a liquidity need, where should I be pulling it from? I have to rebalance portfolios to make sure that I'm comfortable with my risk levels. If, let's say, we've seen equities run a great deal and now I am overexposed based on what my longer term plan is. And the question of when you do that and how you do that means that the medium term remains very relevant. And so when we work with clients, what we want to avoid is them being so short term focused that they lose sight of the longer term goal and the plan that they have in place, and knowing that the plan accounts for the fact that we will experience volatility, and reminding people and really working with people that they know what they own and why they own it, and knowing what own means understanding the volatility structure. But at the same time, we have to always be considering these shorter term decisions that have to be made in the context of where we are today. I'd say the same thing when we think about alternative investments, which I think is important. A lot of people approach alternatives to say, we call it the golden corral approach, which is that I'm at the buffet, just give me one of everything and let me check the box of an allocation. People say I should have private equity, private real estate, private credit, venture, and hedge funds, and so I'll just take one of everything. We actually think that you have to know where you are in the economic cycle. You need to know the backdrop of where the different drivers of those different asset classes are, things like interest rates, things like valuations, because there is a time and a place for every asset class. So for example, we saw a lot of disruption in venture back a couple of years ago, so we stepped into venture. Disruption in the short term creates opportunity in the long term. We did something similar with private equity, being very hyper-specific, hyper-focused. So that's where, where as much as we like to encourage people that the short term doesn't matter, we still consider it even in making those longer term decisions, because it can open up, again, that notion that disruption creates opportunity. And we think that that's really important to remember in kind of navigating, what are these uncertain cycles.
All right,
and
so
I have no idea how long the bull market is going to last. Who knows?
I think 8 years. So I look at it. I'm going to tell you a quick story that's going to end in a question. It's going to be quick, Jim. I promise.
Everyone set your timers when Bobby tells
And by the way, calling me loud is a compliment, and it's not the first time I've heard it. It's a huge compliment to me. I have a cousin named Anthony. Strange, right? I have a cousin named Anthony. And he called me up a while ago, and he goes, my financial guy, he's like, I got to get rid of him. He goes, we were up a lot of money, and then COVID hit, and we lost a lot of money, and then he didn't get right back in on the bottom of the COVID and make a lot of money back, and I just think he's messing up. And I immediately said, I can have you call Cameron Dawson, but I stopped for a second, and I thought, this is incorrect to think this way. So I got him and his advisor on the phone at the same time, and I said, can you explain to my cousin why his portfolio performed the way it did? How do you deal with, you've had that call, I know you have. How do you deal with people who say, I was rich and now I'm not, now I'm rich again? And how do you get that sort of balance between telling people you don't have the money when just the stock has gone up?
Well, one of the things that we try to do is prepare people for volatility. So meaning that if you know you are going into a potentially higher volatility period and saying, here's the technical analysis, here are our levels where we think we could get to. Instead of having it be where when we reach those levels, people are picking up the phone and saying, I'm so scared, get me out. We want to train clients to have the opposite response, which is, get me in, this is my time to get in, this is my opportunity. And you can't do that in the heat of the moment. You cannot do that when volatility is already happening. You have to do that. You have to personally prepare yourself, mentally prepare yourself well before that volatility happens. It's like you don't buy flood insurance after the hurricane, you buy it before the hurricane. And this is not you, meaning that you prepare yourself for that kind of opportunity to present itself. One of the things that we do is try to take the emotion out of it. Every time we see volatility start to spike in the market, I run what's called a flush deck. And we send it out to our clients to say, hey, based on these metrics that have this hit rate, we should be buying no matter what. Or maybe there's a little bit more juice to it. One of the interesting observations over the last about 2 years, ever since the October low, is that when I've run that flush check, every time we've seen a time like August 5th, for example, you never have hit extremes. You've never hit levels that would be back up the truck kind of moments, because the market has anticipated those. So, maybe it's that everybody else has their own flush check and it becomes a self, kind of reinforcing policy, but we do think that taking the emotion out is absolutely necessary in trying to have those discussions.
Okay, so it's no secret over the last 2 years, Magnificent Seven, that part of tech, has done the majority of the heavy lifting. Okay, now you are looking out to 2025. I don't know if you've heard, but we have an election. It was in some of the papers.
No,
I don't know that it was
really?
in all.
When is it going to
I don't
be?
know exactly.
Yeah.
That part is
Who's
kind of
running?
foggy. I don't know.
Yeah.
But anyway, based on the results of that, based on any other metric that you can think of, what are the themes of 2025 as far as rotation? Will tech still be the leader? Switch to the Russell, switch to commodities? You go. And also, by the way, this is my last question. I got to go because I got to get a wedding, but Bobby and Cameron will take you home.
It's not my wedding.
It's not my wedding, yeah. Or mine, by the way.
I can't help but think of the quote from Walter Deemer, which it's Walter Deemer's law of perversity, which goes, the market will do whatever it takes to make the greatest fool out of the greatest number of people to the greatest possible extent. And that's relevant in the realm of sector rotation, because what we see in things like flows from a sector perspective into tech, for example, is that it's been the only sector that has garnered flows over the last couple of years. So the challenge we would see, and where we have to be, I think, very clear-eyed in looking at tech, is to say, we know it's crowded, we know it's expensive. Here's the other catch. Tech earnings estimates are for 17% in 2024. They're now forecasted for 25 to accelerate to 25%. Now, that's happening in the context of NVIDIA, one of the largest weights in tech, going from 140% growth down to 40% growth. So you're losing a big source of growth as you move into 25. So we're certainly in a never say never, when it comes to tech, and we know that these are some of the greatest companies in the world, if not the greatest companies of the world. Tech remains in an uptrend. I think that that's the other important point, is respect the trend, keep respecting it, but we have to be aware, or at least prepared to not be surprised if tech underperforms next year. We believe in the fundamentals of tech most certainly, but because of that setup and valuation, positioning, and sentiment, and earnings expectations, have an open mind.
Next time we're getting 3 mics. I swear we're going to splurge on
It's
the
a
third
bull
mic.
market. We should have 3 mics.
Yeah, we're a little cheap. What are you going to do? There's a dynamic going on that I've asked a lot of people about, and you have a background in industrials. This doesn't really apply to the question, but I always like to point that out.
Oh, thank you.
It's an impressive background. Right now we have equity markets hitting new all-time highs. We also have gold hitting new all-time highs. Now, I've had people say it's global chaos that's possibly pushing gold. I've had people say, well, gold is starting to prepare for the fall in equity markets. I personally think, along with the rise in longer-term yields, that gold and yields see inflation down the road.
Yeah.
What do you think it is? Because it is unusual, right, to have the two hitting new all-time highs at the same time. What do you think it is?
Well, I don't think that we can ignore the central bank buying of gold as well, because of the weaponization of the dollar post the Russian invasion of Ukraine. And there's a lot of great books that have been written about that weaponization and how it has certainly shifted the priority of global central banks away from dollars, away possibly from treasuries, into gold. So we do know that aspect is happening. It's quantifiable. When it comes to inflation, if you were to say we have a strong growth backdrop and we're going to run fiscal deficits as if we're in a crisis, and we're going to do the largest non-recessionary cutting cycle of the last 40 years, your Econ 101 reaction to that would be, of course we're going to have inflation, right? Because you're getting stimulative policy from fiscal and monetary into a strong economy that doesn't necessarily say it's screaming for it. The thing that we're watching is that we're not yet seeing signs or evidence of that yet. So we're watching, if you put into 3 key buckets of what we think could drive inflation over the course of the next few months. The first one is wages. You're not seeing it in wages where they're turning higher. The best leading indicator for wage growth is the JOLTS quits ratio. So if people aren't quitting their job as much, you're not seeing that same kind of lift in wages. So watch JOLTS quits. The next one is housing. You're not seeing a big turn in the present kind of rental indicators. So not those lagging housing components of the CPI, but you're not seeing those turn higher. And the last one being energy prices, which is something that's exogenous to the system and could provide a shock. Oil going over $100 a barrel, we might blame the Fed if that happens because all inflation would accelerate higher, but the reality is it's kind of outside of their control to an extent. So when you put those 3 buckets, wages, housing, and energy costs, we're not seeing those signs yet that you're going to have runaway inflation, but we're not necessarily ruling it out as a potential in 2025 to say that you don't even have to see that much of an uptick in inflation to really shake a bond market that's still expecting an aggressive Fed. I would also just point out somebody like Mike Green's work over at Simplify, who talks about the seasonality of inflation. He talks about how Jan, Feb, March have typically had this acceleration. So, let's say we have this big Santa Claus rally through the end of the year. Wouldn't that be fun if we had some hot inflation prints that could jostle markets and say, oh, Fed can't cut and we're doing too much fiscal. You get volatility bond market, volatility equity market. That's something we should not rule out as a potential outcome.
Yeah, I think I've said this before. If you took an economist and dropped him or her down from Mars and said we've got 4.1% unemployment, we've got around 3% GDP, we've got about 2.8% inflation, do we cut rates by 50 basis points? Do you think the Fed is
hundreds of basis points?
Or hundreds of basis
saying,
points?
Yeah.
I'm not looking at my watch because you're boring me. You have a keynote. I want to be sensitive to that. Would you actually say? Let me ask this 2 ways. What do you think the Fed should do, and what do you think they will do?
Well, we've been of the camp that Fed policy isn't nearly as restrictive this cycle than it has been in prior cycles, for the key reason that the makeup of the U.S. economy's balance sheet is incredibly different in aggregate than it was in prior cycles. You can look, of course, we all know the stats about mortgages and the percentage of floating rate mortgages being far lower. Those numbers are 35% of mortgages were floating rate in 2005. In 2022, when the Fed started raising rates, it was 5%. So what happens is the Fed raises rates. What you've not seen is this concomitant increase in interest expense in aggregate. And in fact, if you look at corporate net interest expense over the course of 23 and 24, what you actually have seen is that it's fallen. Meaning in aggregate, companies are earning more on their cash as interest rates have moved up than they've seen their interest expense go up. So when the Fed is talking about how real rates are so high and we're weighing on growth and the risk is we're weighing on growth, we'd argue that they're actually not that tight, and that it's the reason why if you look at the real Fed funds rate, it only turned positive in May of 2023. And since May of 2023, the U.S. economy has been growing above trend, and you've seen estimate revisions move higher. So our key thesis for 2024 is what we called, as we said, we didn't think we were going to have a hard landing or a soft landing. We're calling it a strange landing. And that strange landing appreciates the fact that you still have this huge overhang from the pandemic, the policy response to the pandemic that is distorting how this cycle behaves compared to prior cycles.
So why then is manufacturing PMI weak globally and especially in the US? And I ask you that because I pay a lot of attention to that because in the past, manufacturing PMI is highly correlated to stock performance. Do you think the rest of the economy pulls it up, or is it just not, it doesn't matter anymore?
Well, we can't ignore the fact that there still is the overhang from a big supply chain bullwhip effect within manufacturing. You go back to 2020, 2021, you talk to manufacturing companies, they said, we're going to raise prices as much as we possibly can, 10, 15% every quarter. We are running at full speed. We're building inventory because demand is limitless. And lo and behold, once again, they got over their skis, and you're seeing that start to kind of revert back. Because what's interesting is that if you look at goods demand from a consumer perspective, it actually has remained really resilient and continues to make new highs. So yes, you saw some pull forward in the pandemic from a goods perspective, but overall, you're still seeing that healthy end demand. We do think that there is an aspect of higher interest rates weighing on manufacturing companies. We've heard it. We speak to a lot of private credit players, and private credit players are saying, hey, look, if you see interest expense as spreads come in and base rates come in, if you see that interest expense come down, that does allow these companies to invest more in their business, potentially hire more people. But it is very much a field of dreams sort of question of if you build it, they will come, meaning that they have to have the demand there in order to have the confidence to do it. So we take PMIs with a grain of salt. They're not the greatest indicator, but they do paint an interesting story about the future of earnings growth in the U.S. There's a great portion of the PMIs where you do the new orders to inventories spread, and it typically leads S&P 500 earnings. It's one of the stronger relationships, and that points to pretty mediocre earnings growth next year. Why is that important? The street has 13% earnings growth next year. So it's another example of those divergences that may or may not hold. Again, strange landing. A lot of these relationships have broken down, but just be aware that there could be that room for a surprise, at least based on what PMIs are saying.
Cameron Dawson, Chief Investment Officer, New Edge Wealth. We always go to our audience and say, do you have any questions for this guest, for that guest? You want to know what the number one question was for you?
Oh, goodness.
What's at the top of your music list right now?
Oh.
Because you have that music tie into your note all the time.
Yeah. Oh, what am I listening to right now? Well, I just got to see Coheed and Cambria play at the Garden, and they are a sci-fi themed metal band, and they're amazing. So
you are so Brooklyn now.
Yeah,
it's amazing. You are so Brooklyn.
but they're fantastic. So, but you know me, I love classic rock. I'm a big '90s rock fan, and so anything I can sing along to and thrash my head around, I'm a happy camper.
Where can people read your stuff, find you?
You can go to the New Edge Wealth website, newedgewealth.com, as well as I'm on LinkedIn and on X at Cameron Dawson.
Did the light just go off?
Oh, it certainly did.
Yeah. Is that many times up? Did you stop?
Yeah, it's like a journey song.
It's like the 5-minute thing? It's like what?
When the lights go out.
Oh,
Never
jeez, I
mind.
should have known
well.
that. I am Bob Iaccino. This is Cameron Dawson. I hope you enjoyed this. Jim Iuorio had to go. He had to catch a flight back to Chicago to attend a wedding that was not Cameron's. Thanks, you guys, for all your support. Again, the reason why we do this is because we enjoy saying what we think, saying shit and cuss words every now and then when we want to. And
Family
we really,
show.
really appreciate, we're humbled by the support. Cameron, thank you for being here.
Thanks for having me.